Welcome back to the Pro Ticker Podcast, everyone. Your Tuesday morning edition covering major financial magazine headlines.
Yeah.
Today, we're diving deep, into all those forces that are shaping the financial markets. From Bitcoin's latest surge to BlackRock's maneuvers and a few global trends that might have you, raising an eyebrow.
Indeed, it's a fascinating landscape right now. We'll be connecting the dots between global events and your portfolio. Think of it that way.
Okay, all right, so let's start with something that's been making headlines. Bitcoin. The Wall Street Journal is reporting that it is nearing $100,000 again.
Wow.
And a lot of you are probably thinking, here we go again.
Right.
But this time it's not just about the price of Bitcoin itself. It's about what this surge is doing to some pretty interesting financial products.
You're talking about those leveraged ETFs that are tied to MicroStrategy.
Yeah.
The company that's bet big on Bitcoin, the Wall Street Journal highlights how these ETFs, they use swaps and options.
To amplify MicroStrategy's returns. So in theory, if MicroStrategy stock goes up 5%, the ETF should double that to a 10% gain.
Oh, wow.
But in reality, things haven't been so straightforward.
So the article mentions that a lot of investors are complaining because these ETFs aren't living up to their promises,
Right,
especially when the market gets volatile.
right.
What's causing this discrepancy? Is it just the inherent risk of leverage, or is there something more going on?
Well, leverage definitely plays a role, but the mechanics of these ETFs is where things get really interesting. They rely on swaps, which are contracts that allow them to magnify returns.
Okay.
But when volatility spikes, as it often does with Bitcoin,
Yeah.
those swaps become a lot harder to come by.
Oh.
So then the fund managers have to turn to options, which can actually exacerbate the volatility.
So it's like a vicious cycle.
Exactly.
Bitcoin's volatility makes it harder for the ETFs to perform as expected, which could lead to even more volatility as investors react to the underperformance.
Yeah.
And on top of that, the article points out that some of these ETFs are experiencing what's called a short squeeze.
Yes.
This is where investors betting against MicroStrategy are forced to buy back shares to cover their losses, pushing the price up even further.
Exactly. It's a reminder that these leveraged products can be incredibly risky, especially for those who don't fully grasp the complexities.
I see.
And it highlights that even in a bull market, not all boats rise equally. Sometimes the mechanics of a financial product can work against you.
Yeah, that's a great point. It's not just about picking the right asset, but also understanding the vehicles you're using to invest in it.
Exactly.
Now, shifting gears from the world of volatile cryptocurrencies to the more traditional realm of finance. Bloomberg has a story about BlackRock,
Yes.
the world's largest asset manager, making a significant move into private credit.
Yeah, the $12 billion acquisition of HPS Investment Partners is a major statement. It's not just about the size of the deal, but what it signals for BlackRock's strategy and the broader financial landscape.
So for those of us who aren't familiar with the term, what exactly is private credit? And why is BlackRock, a company known for managing trillions in more traditional assets, so interested in it?
Sure. So private credit is lending money to companies outside of the traditional banking system.
Yep.
Think of it as an alternative for companies to get funding often from institutions like hedge funds or giant asset managers like BlackRock.
Interesting.
What's attractive for BlackRock is that private credit often offers higher returns compared to public markets, especially in a low interest rate environment.
So it sounds like they're looking for new avenues of growth, especially as investors become more interested in diversifying their portfolios beyond stocks and bonds.
That's exactly it. This move by BlackRock speaks to a larger trend where big players are seeking returns in less conventional areas. Private credit can be lucrative, but it's not without risk.
Of course.
It can be less liquid than public markets, so it's harder to sell your investment quickly if you need to. And there's always the risk that the companies borrowing the money might default on their loans.
Especially during economic downturns.
Especially during economic downturns.
So high risk, high reward, even for a company like BlackRock.
Absolutely. But they have the resources and expertise to navigate this space. For individual investors, though, private credit is a complex area that requires a certain level of sophistication.
So let's zoom out and take a look at some broader market trends that are causing a bit of unease.
Okay.
What have you noticed?
Well, CNBC is reporting on the euro's decline, which is being fueled by a potential government crisis in France. And this political instability is spooking investors who are selling off the euro and raising concerns about the stability of the European economy.
Political turmoil rarely bodes well for a currency.
Right.
And the article even suggests that if the French government collapses, it could derail plans to address their growing budget deficit which would further erode investor confidence.
Yeah.
But it's not just Europe that's seeing instability. The Wall Street Journal has a report about Paloma Partners, a well-established hedge fund facing a wave of investor withdrawals after years of underperformance.
It's a stark reminder that even veteran players in the hedge fund world are vulnerable in today's environment.
Yeah, Paloma Partners, despite its history, has struggled to keep up with the returns of larger, more agile hedge funds.
Like Citadel and Millennium Management.
Right. And their recent struggles have led to investors heading for the exit.
Absolutely.
The article even mentions that they're offering investors IOUs instead of cash to meet redemption requests.
Wow.
Which is a pretty unusual and concerning development. It suggests they're having difficulty selling assets quickly enough to meet demands.
Yeah, and this situation really highlights the changing landscape of the hedge fund industry. Investors are demanding higher returns, lower fees, and greater transparency. The bigger players with their vast resources and sophisticated strategies are in a better position to deliver on those demands.
So smaller firms are finding it increasingly difficult to compete.
Exactly. Paloma Partner struggles might be a harbinger of things to come for others in a similar position.
So even in the world of hedge funds, it seems size and agility are becoming increasingly important.
Definitely.
And while we're talking about market trends, CNBC also notes that gold prices have dipped recently. What's driving that decline?
Well, there's a couple factors at play. The U.S. dollar has been strengthening lately, which usually puts downward pressure on gold prices since gold is priced in dollars.
Right.
When the dollar goes up, gold becomes relatively more expensive for buyers using other currencies.
Okay.
Also, there's a growing sentiment that the Fed might not be as aggressive with interest rate cuts as previously anticipated.
So the safe haven appeal of gold is diminishing a bit.
Yeah, as the market seems less worried about immediate economic turmoil.
But speaking of the Fed, they always keep us guessing.
Yeah.
Bloomberg has a series of articles featuring statements from Fed governors Christopher Waller, John Williams, and Raphael Bostic.
Right.
And they all seem to be hinting at different things regarding future interest rate decisions.
Yes. Deciphering the Fed's intentions is always a bit of a puzzle. Waller appears to be open to a rate cut in December, but he's also cautious.
Okay.
He's emphasizing that the decision will depend on incoming economic data, particularly on inflation.
So a bit of a wait-and-see approach from Waller? What about the others?
Well, Williams seems to be taking a more dovish stance. He's focused on the long term and believes that more rate cuts will be necessary over time to support the economy and keep inflation in check.
So we have Waller playing it cautiously and Williams leaning towards cuts. Where does Bostic fit into all this?
Bostic seems to be somewhere in between.
Okay.
He's keeping his options open for December, stating that he wants to see more data before making a decision. Essentially, he's sitting on the fence for now.
So the Fed is sending mixed signals, which isn't exactly surprising, but it does make things tricky for investors
Yeah.
trying to navigate this uncertainty. What's your advice for those trying to make sense of it all?
I think the key is to remain flexible and avoid making any large bets based solely on short-term pronouncements from the Fed. Ultimately, it's the economic data that will dictate their course of action.
So keep an eye on those key indicators like inflation, employment, and GDP growth.
Exactly. Those are the real drivers.
All right, now let's switch gears and look at a development with global implications. Bloomberg has an interesting article about Russia's oil strategy,
Yes.
particularly their decision to increase oil exports ahead of the upcoming OPEC+ meeting.
This move by Russia is quite strategic. By ramping up exports now, they're essentially trying to increase their market share and put pressure on OPEC to delay any planned output increases.
So they're flexing their muscles a bit.
Yeah, showing that they're willing to act independently of OPEC if it serves their interests.
And this comes at a time when Western sanctions on Russian oil haven't been as effective as some had hoped.
You're right. The article even mentioned that Russia has managed to maintain its oil flows despite the sanctions, largely by creating a shadow fleet of tankers that operate outside the purview of Western authorities.
Wow.
This has allowed them to continue selling their oil, though often at a discounted price.
So what are the potential outcomes of this upcoming OPEC+ meeting, and how might they impact global oil prices?
Well, there are a few possible scenarios. If OPEC Plus agrees to delay the planned output increases as Russia is pushing for,
Okay.
it would likely support oil prices, potentially leading to further increases.
Especially with demand remaining strong and the holiday season coming up.
Exactly. But there's also a chance that OPEC Plus could fail to reach an agreement,
Right.
which could lead to increased production from member countries, potentially pushing oil prices lower.
I see.
It's a delicate balancing act for OPEC+. They want to maintain stable oil prices, but they also don't want to cede market share to countries like Russia, and they have to factor in the global economic situation.
That's right. The global economy is still facing various challenges, and a significant slowdown in growth could reduce oil demand.
Yeah, putting downward pressure on prices. So it's a complex equation with many variables.
It is. Now let's shift our focus back to the U.S. and discuss some positive news for the IPO market.
Okay.
Bloomberg reports that Service Titan, a software company catering to home and commercial contractors, is aiming to raise over $500 million in its IPO, potentially becoming one of the last major listings of the year.
Wow.
So even with all the market uncertainty, there's still an appetite for new tech IPOs, particularly for companies with a strong track record of revenue growth.
Yeah, and it's worth noting that they're backed by some prominent venture capital firms,
Wow.
which adds to their credibility and signals to the market that they have a solid foundation and a good chance of success.
So this IPO is a positive sign for the market.
Yes, it suggests that there's still investor interest in high-growth tech companies.
It's a bit of a bright spot amidst all the global and economic uncertainty. Now, before we wrap up this part of our deep dive, let's take a quick look at the overall stock market performance.
Okay.
Bloomberg has an article summarizing the latest trends, and it appears U.S. stocks are on a roll, hitting new record highs.
That's right. The S&P 500 is having its best year since 2021, driven by a few factors, including strong corporate earnings optimism about the economy and a preference for U.S. assets over international markets.
And the article mentioned that short sellers, those betting against the market, are capitulating.
Yeah, meaning they're giving up on their bearish bets and buying back shares to cover their losses.
It's almost like a self-fulfilling prophecy.
Exactly.
The market's resilience is forcing those who bet against it to fuel the rally even further.
Right. But as we all know, market sentiment can change quickly.
Oh, definitely. That's why it's so crucial to maintain a diversified portfolio, have a long-term investment plan, and not get caught up in the short-term fluctuations of the market.
Absolutely. Staying focused on your goals and managing risk is key.
Well said. Now, before we move on to the next part of our deep dive, I want to touch on something we haven't discussed yet. MarketWatch has this article with some pretty bold predictions for 2025.
Uh-huh.
One that caught my eye is the possibility of the U.S. dollar taking a significant tumble.
Ah, yes, the annual outrageous predictions from Saxo Bank.
All right.
They always make for an entertaining read.
They do.
Huh.
But this prediction about the dollar seems especially relevant given our discussions today about the tensions between the U.S. and the BRICS nations over the dollar's dominance as the global reserve currency.
It's definitely a hot topic. And Saxo Bank's prediction hinges on the idea that President-elect Trump will implement policies that ultimately weaken the dollar.
Interesting.
They envision a scenario where Trump enacts massive tariffs and drastically cuts deficits, potentially leading to a shortage of dollars in the global financial system.
It sounds pretty dramatic.
It does.
But I suppose it's not entirely outside the realm of possibility.
Mm-hmm.
What would that mean for the global economy?
Well, according to Saxo Bank, it could force other countries to seek alternatives to the dollar,
Okay.
potentially leading to the emergence of gold-backed currencies or even crypto stablecoins.
It's a radical vision,
It is, but it underscores the potential vulnerabilities of the dollar's dominance.
especially if the U.S. continues down a path of protectionist policies.
Exactly.
It definitely gives us something to think about. But remember, these are just predictions.
Yeah,
And tons of other factors could influence the dollar's trajectory in the coming years.
absolutely. The future is never set in stone.
Right.
And while predictions can be fun to consider, it's important to focus on what we can control, like our own investment strategies and risk management.
Wise words. And on that note, we'll wrap up this first part of our deep dive. We've covered a lot of ground, from Bitcoin's volatility to BlackRock's foray into private credit, from European instability to the Fed's mixed signals, and even a glimpse into Russia's oil strategy, and some bold predictions for the future.
It's been a whirlwind tour of the financial markets, highlighting how interconnected these seemingly disparate events can be and how they can all impact your investment decisions.
And we'll continue our exploration in the next part of our deep dive. But for now, we'll leave you with this question. Given all the factors we've discussed, what opportunities and risks do you see emerging in the market?
That's the question every investor needs to be asking themselves, and the answer will vary depending on your individual circumstances, risk tolerance, and investment goals.
But the first step is to stay informed. Keep reading, keep learning, and keep asking questions. And don't be afraid to seek professional advice if you need it.
Great advice.
We'll be back with part 2 of this episode shortly after a quick break.
Picking up where we left off, let's look a little deeper into those outrageous predictions from Saxo Bank. Another one that caught my eye is their forecast for Nvidia.
Oh yeah, that one was pretty wild. They're predicting that Nvidia could become twice the size of Apple in terms of market capitalization.
It is a bold statement considering Apple's current position as the world's most valuable company.
Yeah.
But it's not totally implausible if you consider the explosive growth of the AI market
Right.
and Nvidia's position as a provider of the chips that power it.
That's a good point. Nvidia's chips are already essential for everything from gaming and self-driving cars to AI.
Right.
And as AI continues to advance and become more integrated into our lives, the demand for those chips is only going to increase.
Exactly. And Saxo Bank's prediction hinges on the idea that this surge in demand will propel Nvidia's valuation to new heights, potentially even surpassing Apple.
It's a fascinating, if speculative, scenario
It is.
that raises some interesting questions about the future of the tech industry.
It certainly does. If Nvidia were to become that dominant, it would have a huge impact on the competitive landscape,
Yeah.
potentially leading to a winner-take-all dynamic where a few companies control the most crucial technologies.
It's exciting and a little daunting to contemplate the possibilities.
It is. But one thing is for sure. AI is a transformative force that will continue to disrupt industries and reshape the world.
That is a thought-provoking point to ponder. So as we wrap up this deep dive, let's take a moment to reflect on what we've learned. We started by examining Bitcoin's latest surge and the challenges faced by those leveraged ETFs tied to MicroStrategy's performance.
We then explored BlackRock's strategic move into private credit, which says a lot about their search for new avenues of growth and the changing landscape of the financial industry.
We also analyzed some broader market trends causing unease, including the euro's decline amidst political turmoil in France and the challenges faced by a veteran hedge fund struggling to adapt to a changing investment environment.
And we even explored those bold predictions from Saxo Bank about the future of the US dollar and the potential rise of Nvidia as a tech titan.
It's been a wide-ranging discussion, but I hope it's given you a better understanding of the forces shaping the financial markets today.
It's a complex and ever-changing landscape, and staying informed is really important. By looking closely at these headlines, analyzing trends, and considering different perspectives, we aim to equip you with the knowledge and insights you need to navigate this world.
Exactly. And remember, even amidst all the uncertainty and volatility, opportunities exist for those who are well-informed, prepared, and willing to adapt. So stay curious, keep learning, and remember to diversify those portfolios.
And never hesitate to seek guidance from a financial advisor when needed.
Absolutely. Now, on that note, we'll wrap up this deep dive. We appreciate you joining us this morning for our exploration of the financial markets. We'll see you all tomorrow morning with new headlines from major financial magazines.
I think the most important takeaway from today is this. In a world of information overload, it's not just about knowing what happened, but understanding why it matters.
Yeah, we saw how a seemingly small event like a government crisis in France can ripple out and impact the value of the euro, or how Russia's oil strategy could shift the balance of power within OPEC.
Right, it's all connected.
It is.
And for you, the listener, it's about recognizing those connections and how they might impact your financial decisions.
Right.
Are you overexposed to the dollar?
Yeah.
Do your investments align with the growing importance of AI? These are the questions we hope this deep dive prompts you to ask.
It's not about giving you all the answers, but giving you the right questions to ask yourself.
Exactly.
And the tools to find those answers.
We're not here to tell you what to do, but to help you make informed choices based on understanding the forces at play.
And that's what this is all about. We go beyond the headlines, examine the context, and explore the implications. It's about connecting those dots and seeing the bigger picture.
And as we've seen today, that bigger picture is always evolving. The financial markets are dynamic and complex and often unpredictable.
Yeah.
But by staying informed, remaining adaptable, and thinking critically, you can navigate these waters with more confidence.
And hopefully a little bit of excitement, too, because there's nothing quite like uncovering those hidden connections,
Right.
those aha moments that make you feel like you're really in the know.
It's about turning information into insight and insight into action. And that's the journey we embark on together every time you join us for the deep dive.
So until next time, keep those portfolios diversified, stay curious, and we'll see you all tomorrow morning with new headlines from major financial magazines.